All right, cool. We're live. Understanding and improving credit. First time home buyers. So tonight we're going to talk about credit, understanding your credit, and how you can, some things that you could do to improve on your credit. So what I'm seeing is people coming to me and they're thinking, oh, I need to do this, this, and this in order to get my credit right. However, you're probably listening to videos where people are talking about setting their credit up for business credit or business funding. Business funding to set up your personal credit is totally different than what we're looking at in terms of purchasing a home. Hi, I'm Kevin Jefferson, People's Lender. I am going to help you with some tactics that from a mortgage lender standpoint, not from a guru, not from a credit repair company, not from anyone other than a mortgage lender who's looked at credit, I don't know how many times a day, every day for the last 9 years. And I'm going to help you with some things. If you are interested in getting a specific question answered pertaining to your credit, do me a huge favor, put it in the chat. If you're watching the replay, put it in the comments. I'm going to do my best to answer it, give you tactical and practical steps to improving your credit, and we can go from there. So cool. The first thing that you need to do, and I said it the last couple of weeks, is to go to annualcreditreport.com. And when you go to annualcreditreport.com, you don't necessarily have to pay for the 3 scores, right? You need to just be able to pull off your credit report and see exactly what is on your credit report. Once you look and get an idea of what's on your credit report, then we take a look at how to potentially improve scores. I tell people, hey, get a marker, highlighter, or something to highlight a few things. Highlight, use one color to highlight collections, do another one to highlight anything that you're not familiar with, and then make sure the accounts that you are familiar with, are in good standing, right? Some of the biggest things that are hindering people on their credit have been excessive credit card debt, student loan payments or lack of payments, meaning they have not made a student loan payment and they've been late simply because they weren't aware that they were no longer in the government forbearance. Medical collections are something else that I see on credit reports pretty frequently. Medical collections are probably the easiest thing to do a pay for deletion with. But there's a specific way that you need to do it in order to make sure it does actually get deleted from your credit report. Another thing that I'm seeing is, and I'm not just seeing, but I've been seeing, so progressive auto insurance. If you have or have had progressive auto insurance, and progressive auto insurance, and you left Progressive, let's say you left Progressive and went to a different auto company, a homeowner car insurance company, and it was not the end of your term, Progressive auto insurance has some sort of clause in their contract that states you have to pay a fee. Now, the fee has never been the same for as many credit reports that I've seen, and they don't send out a collection letter. They just send you to collections after a while if they don't get that payment. How I know is years ago, I had Progressive and I left Progressive and went to a different company. And when I started looking for, I can't remember if I was looking for a car, it's probably a home. I was looking for a house. I found out that I had a Progressive bill on my credit and I wasn't sure why, because I had made my last payment. So we're going to discuss the Progressive bill, if you have it, and we're going to discuss medical collections. Those are probably 2 easiest things to do a pay for deletion. right? So when you're looking at your credit report, I guess while you're doing it, you can look and make sure the addresses are accurate. If you live at 123 Main Street currently, you can call the credit agencies and say, hey, could you please remove all addresses other than 123 Main Street anywhere USA from my credit report? And then do the same thing when you take a look at do the same thing when you're looking for phone numbers. If there's phone numbers on there, make sure it's an accurate phone number, and get rid of the ones that don't pertain to you. That's just something to kind of clean up your credit report. It doesn't stop you from getting approved. It doesn't help you get approved. But that's one thing just to kind of make it simpler and clean up the credit report, right? The next thing is you want to make sure that you're familiar with what's on your credit. You want to make sure that you look for any type of late payments, because we're looking for lates in the last 12 months. We're more so concerned with lates in the last 12 months. Whether it's a car payment or credit card or personal debt, we're looking at that to make sure that your credit is on point in the last 12 months. You want to make sure that your student loans, again, are in good standings. If you don't know, unaware, tomorrow morning, if you're watching the live or the replay, or it's a year from now, call your student loan servicer and get in good standings with them. You want to make sure you're in good standings, because what happens is when a student loan reports late, it reports late 90 days. And if you have 5 student loans that report separately on your credit report, and each one of them goes 90 days past due, that's 90 days, 5 times reported on your credit report. I'm sorry. 90 days past due. So you want to make sure you're in good stands with your student loan servicer. You want to make sure that if you know that you're not in good standing with your student loan servicer, call your student loan servicer and ask them to set you on some sort of payment plan so that we can get out of default. If you have done credit repair before and it is no longer reporting on your credit report for some reason, that does not mean 2 things. It does not mean we will not find out about it, and that does not mean you do not owe your student loans. So there's something called CAVERS. CAVERS is a government system that we look in to see if there's any defaults on federal debt. While it may not be reporting on your credit report, it could be reporting on CAVERS as a default. When we pull up CAVERS, they find any type of government money that's owed, whether it's an overage of Social Security, whether it is student loans that are in default, tax liens, anything dealing with the government. There's a possibility that you will show up on CAVERS. So just remember, because the student loans don't report on your credit report, doesn't mean we won't find them. And that does not mean that you don't owe them. And the reason why I say it does not mean that we won't find them, if you don't pay and they report you late and then you continuously report late, but it's not affecting your score because for some reason it's not on your credit report and it goes into default, that can hinder you from purchasing a home. So just be aware of that with the student loan debt. In terms of credit cards, Ms. Jones said, just to confirm, the credit card company does not report it late until 30 days past due, correct? That is correct. Credit card companies do not report you late unless it's 30 days past due. Now, something that is a misconception, a late fee and being 30 days late are 2 different things. Typically, you have like a 15-day window before they charge a late fee. And when they charge the late fee, that's one thing. That doesn't mean they reported you 30 days past due. When you are past 30 days past due and you have a late fee and they have the ability to report you late on your credit report. Some companies don't report you until you're 60 days past due. However, most do a 30 days past due. And I'm going to be honest with you, they do not care what you had go on in your life and why you were 30 days past due. The person answering the phone does not know how to get it off. They're going to give you the same generic answer. Hey, I was late. Oh, we're sorry to hear that, Mr. and Mrs. Such and so. Is there a way we can remove it? Well, you'll have to reach out to the credit agencies and dispute that item. Well, when you dispute the item, it's going right back to whoever the company is, and it's going to come back verified because neither party is going to do their due diligence in terms of, hey, is this a valid reason? They're going to do the quickest way. And right now it's typically done with technology and it comes back verified. So you want to make sure a couple of things. You want to make sure that any credit card payments you have, put it on auto pay. If you put it on auto pay, it's kind of set it and forget it. However, like I've got my Capital One on auto pay, and it will notify me, hey, your payment is due such and such date. And then you got that reminder. So if you funny on the money, on your money at a certain period in the month, at least you know that, hey, this payment is coming out. Let me figure out a way to get that $30 or $50 in there so it automatically comes out. So credit cards, late payments, student loan debt, lates on your mortgage. So another thing about your credit, if you're late on your mortgage, you're going to have to wait an entire year before they will allow you to finance a home. Because if you're late on your mortgage, they don't want to see any lates at all in the last 12 months. And if it's, they've got a guideline that says extenuating circumstances, but I've yet to see an extenuating circumstance that got over a mortgage late. So you want to make sure, if you currently have a mortgage, you want to make sure that you keep your mortgage on time as well. The other thing is, if you don't have any credit, then you could do a couple of things. You can get a secured credit card. At the end of this video, in the description, there will be a link to a secured credit card, which is a soft pull, and they report to all 3 credit bureaus. The reason why I like referring my clients to this particular secured credit card is because they will they report quickly, they do the soft pull, and they report to all 3 credit agencies. Not all secure credit cards report to all 3 credit agencies. I've seen some that only report to 2. I've seen one that report to 1. Why? I have no clue. The other thing is, I like it because as long as you have not had or do not owe them any money previously for a secure credit card, you're going to, so what a secure credit card is you're going to put up $300, let's say $300, and they're going to give you a line of credit. They're going to hold that $300, and then you'll be borrowing against it. So using your credit card. So you give them $300, they give you a limit of $300. The goal is not to run up the credit card to $299.50. The goal is to keep that balance. And this is where you guys, what you may hear online actually makes sense. You want to keep the balance within 10%. So that's $30. If it goes the 90%, yes, that's still in the good ranking. However, you see better results if you keep it around 10%, right? What I don't want you guys to do is right now, if you're trying to establish credit, try to get creative and tricky and figure out how to get a credit card and then get points so you can get free flights and trips and different gadgets, and trying to play in the system by running up the card and then not being able to pay it off. And then it keeps you with a high balance. So you want to keep it to 30 to 10%, 30 to max, at 10%. Or 10%, and that allows for you to maximize your scoring potential. Secure credit card is going to have a different effect on each person, depending on what's on your credit. Now, if you don't have any credit at all and you get a secure credit card, it's going to take up to 6 to 7 months in order for a score to be established because you don't have anything on your credit. Even if you've had credit before and then you hadn't used credit in a long period of time, you're then going to also need to reestablish credit between 6 and 7 months, right? So I've seen people not think they had credit, and they had credit because a collection popped on their credit for some reason. And in that case, it establishes credit because you have something reporting, even though you did not extend through a line of credit, extend credit with that company. Another way to increase your credit score is to potentially become an authorized user on a family member or friend's credit card. Now, listen, this is what you want to do. You want to get with a person who has a long, good credit history, preferably a somewhat high balance or low to no balance, high limit, low to no balance, and no lates, so you can get their credit history. Now, two companies that do not, so example, if a person has a credit card and it's been established for 10 years, and let's say they have no lates, their limit is $8,000, and they got a small balance of, let's say, $1,500. That's somebody whose credit card you want to get on. Two credit card companies and what happens is you get their history. So you get that full 10-year history showing no lates, you get the limit and the balance, which should help increase your credit score, right? If you have little to no credit or medium credit, if you got a ton of credit, that authorized user card is likely not going to help you because you already extended your credit. Yes, it brings down your utilization. However, it does not have the same effect as if someone who did not have credit and trying to establish credit. Now, when you're looking, if you're looking to move quickly, avoid American Express and Discover. The only reason why I say avoid those two is simply because they do not give you the person's history. They'll let you be an authorized user, but they don't give you the person's history. Your history starts once you get added as an authorized user. If the person and I would not take it, if the person that you're going to be an authorized user on their account, just let them know, hey, I don't need a credit card. They don't have to send it to me. I don't need a credit card. They don't have to send me anything. I just want to receive the credit. But you got to make sure that person has a low balance. I've seen people be added as authorized users. The person had a high limit and a high balance, and it didn't help them as much as you would think they would want to. Those are really key points in establishing credit, improving on your credit. You want to make sure you keep low balances. Listen, guys, I know that sometimes there's more month than money. Things happen, your car tear up, kids need something, hospital bill, you need something, life's, right? But we have to figure out a way to keep our debt down and be strategic in how we utilize our credit. We don't have to get a ton of things to establish credit. We don't have to be creative. We don't have to necessarily go to credit repair. You just want to establish your credit. If you were late and you're late, why spend $500, $600, $700, $800, $1,000 to get something removed from your credit when it's going to take time, and it could cost you time and money. And I'm not saying, listen, I refer people to credit repair because sometimes there's a need for it and there's things that they can do to help. But when you see somebody online saying they can help you get your credit from a 5 to a 800 in 90 days, I'd be very skeptical of it, because credit does not go up as fast as it goes down, right? It goes down way faster than it does go up. Another thing, so example, let's say you were late on a credit card payment and your score dropped from a 650 to a 600. When you pay that payment, your score does not go back to 650 and it doesn't increase. It doesn't take the late away either. So those are misconceptions that people have as well, that, you know, if I pay this bill or I pay this, pay my credit card payment, I'm caught up. Or it doesn't matter if you pay the credit card off. If you pay it off, the late doesn't go away and your score typically doesn't increase like you think it would. In terms of, same thing with collections. If you have a collection and it pops up on your credit, I venture to say, if you're in the process of purchasing a home, depending on how much that collection is, hold off. Only reason why I say hold off is because you paying it off, unless it's medical or progressive, like I was saying, it's going to be tough to do a pay for deletion. And I know people say, hey, just do a pay for deletion. Easier said than done, because these companies are smart. They're smart. They do a great job on their paperwork. The credit agencies get paid for reporting stuff. Like it's a cycle. So if you get a Verizon bill for $2,500 and you say, oh, I'll just pay it off, that's fine. But know that your score isn't increasing. Know that it's not coming off. You can try to dispute it and get it removed. But Verizon is tough. When I say they keep their paperwork together, they keep their paperwork together. Same thing with Xfinity. Same thing with AT&T. So if you guys, you know, be mindful of whatever collections you have come up, late payments, you know, that's improving credit. And the biggest thing, you know, improving credit is pay on time. I mean, just pay on time as much as you can. Go back and like, we're at the end of the year, right? We're approaching the end of the year, going into a new year. And what you want to do is just sit down, take a look at all your credit card bills, credit card payments, and see what you can get rid of. See what you can pay down. When I say pay a card off or down, that does not mean close that account. Because if you close the account, that's a different story. Then your score will tank because you no longer have that reporting and you lose that history because the account is closed. So because you pay off an account doesn't mean you want them to close it. Just pay it off, freeze the credit cards, like literally put them in a box, put them in the freezer, give them to somebody you trust and hide them if you're not good with them. Just put them away and try not to use them, because it's constantly creating debt. So example, and I'm going to get to you guys' questions. Hold on, let me look up something right quick. If you have questions, drop them. Do me a favor, drop them in the chat. I'll definitely get to them. I'll answer them. I see 2 questions that I have not answered, but I want to make sure I went over this. The first questions I'm going to answer first is anything pertaining to the topic of credit. And then the next ones I'll answer is anything on home ownership. If you're watching this live, do me a huge favor and make sure you hit the thumbs up button. You know, while I look for this, if you need to grab a piece of paper and jot down some notes, I would advise you to do it. Again, we're going over understanding your credit report and improving on your credit. In some cases, you may need a credit repair company, but right now, I want you to get familiar with what's on your credit and utilize the tips and tactics that I've given you to at least try to improve on your credit before you do anything like file bankruptcy or try to get a credit repair company involved to do things which could take you a little bit longer. Someone has a credit card. Uh, mm, mm, mm. Thank you, everyone, for joining tonight for sure, too. What's going on, Miss Jones? I know we gotta be off here by 8 o'clock so you can see your shows. How you doing, Miss Debbie? How you doing, Softer Side? And then I'm Suzannette. I think I said that right. Suzannette. Um, all right. So, example: if a person has a $2,000 credit card balance and their minimum payment is $50 a month, that would be 40 months, between 3.5 to 4 years to pay it. In the real world, with interest, it takes longer. So, example, if you got a credit card payment with $2,000 balance, let's say the interest rate is 24%, and you pay $50 a month, that's your minimum payment. It's going to take you 7 years to pay that credit card off. That's if you don't ever use it anymore. And when you pay in that 7 years, when you pay back, you're going to pay back double what you actually borrowed. So, high interest rate credit cards can get you in trouble. Constantly making the payment on time, it helps, but it takes 7 years to pay that $2,000 off. So, what I would venture to say is, hey, let's be strategic and figure out where we can get some extra cash to pay off the credit card. When I say extra cash, let's look at potentially maybe working some overtime. Or, for real, be honest with you, maybe you drive Uber and Lyft to make some extra cash temporarily to pay down the credit card. Yes, it's going to be some wear and tear on your car, but it could help you get that extra money to pay down on that credit card so you can pay it off. You can also do the snowball effect. You can take the lowest credit card payment, bill, pay that off. Let's say that's $50 a month, and then take away that card, and then you got, let's say, $50 extra, and then you go to the next lowest balance. And then what that does is that helps you see things come off, and it also keeps you motivated to continue paying things off. Now, there's going to be it's going to take some dedication and discipline. But in order to get in that position, it's better. Because think about it, if the bill's $1,000, why go to credit repair and try to get it removed when you can just pay off $1,000? That's the same thing with a collection. I've seen somebody want to go to credit repair and the person's going to charge them $1,000, but the bill was $500. Makes no sense, right? It makes no sense. If you get a tax return, instead of having a second Christmas, as I always call it, take that money and pay off your bills. While it may seem like it hurt and it's a sacrifice in the beginning, you'll feel better because debt can weigh on you. A ton of debt can weigh on you, stress you out, and keep a lot of things. That you become a slave to debt. All right, guys, I'm going to reset the room. Tonight, we're talking about understanding and improving credit, right? first time home buyers, and really anybody, right? These things, simple tactics that you can put into place that I give to you in a one-on-one that can help you in advance. Let's try not to be super creative. Let's do the basics in the beginning just to get our credit done. And then also make sure you reach out to me and grab a call and we can go over it to help position you. Because, these tactics are basics, right, that help. But there may be other things that you may need to do in order to be in position to purchase. And let me go to the questions. Is there a grace period you have to pay your mortgage past the due date? Yes. There's a 15-day grace period that you have to pay your mortgage past the due date. So typically, most mortgage payments are due on the first of the month. You have until the 16th of the month in order to not be considered late. Are there any perks for seniors to pay lower monthly mortgage payments in Georgia? Depending on which county you move to, if you are, the age limit is typically 65, 62 to 65, depending on which county. You won't have to pay school taxes, which is school taxes are part of your taxes that you pay to the city or the county. Those city or county taxes are part of your mortgage payment. So if you're 62 to 65 or 62 or older, typically 65, and you don't have to pay school taxes in the county that you're in, then you can save on your mortgage payment that way. Aside from that, there's no discount on principal and interest to seniors on their mortgage payment or homeowners insurance. It's typically just on the county or city taxes because you no longer have to pay the school taxes. Yeah, Miss Jones, I didn't want to say Ratchet TV. I didn't want to put you out there, but since you said it, is there any way around collections like a hefty down payment or a bank account, ignoring the fact that the money can be used to pay the collection? Yes and no. So if you have a collection in excess of, let's say it's what you got one collection on your credit report, right? In excess of $2,000, we can do a couple of things. We can use 5% of that payment of that balance and put it in, and it counts against your debt to income ratio. Or you could get on a payment plan. And as long as you have a payment plan intact and you pay 3 on-time payments, then we can get you financed using that. Of course, you still have to have the score, but there's no way around a collection without having some sort of balance. And the reason why is, it's not balance, some sort of payment or using some sort of payment. A collection can turn into a judgment. A judgment can turn into a lien. A lien could allow for that creditor to foreclose on your property and you and the mortgage company lose. Also, that lien could become a garnishment. So they could garnish your wages. Now, each state has its own percentage that you can garnish wages. However, that could affect your ability to make your mortgage payment depending on what that is. So even having a large sum of money in some cases doesn't get you around the collection. But if your debt to income ratio can handle that 5% balance that we utilize, then that's a way around without you having to pay the collection off. And you have to have the score, and you have to have the debt to income ratio, and you have to have the assets. So it's possible, but you got to be in a pretty good position. Hopefully that answers your question, Chanel. Budgeting helps to know where your money is going. Do you see what you can reduce is going to do, so you can see what you can reduce and eliminate? Yep. Yep. Budgeting is key. We spend money on things, and $5 here, $10 there. And then he's like, oh, it's just $5. Oh, it's just $10. And all of a sudden you then did it 20 times in a month. And he's like, man, I spent $200 on nothing. Door dashing and Uber Eats, even though I told you drive for Uber and Lyft, like when you doing DoorDash and Uber Eats, think about, yes, for convenience, but you paying $20, $25 for $8 cheeseburger. Or, they got a special 2-piece chicken and biscuit and it's $6.99, and you get the bill because you got to pay the service fee, the delivery fee, and then they want you to tip. Next thing you know, that 2-piece and biscuit costs you $30. So it might be simpler just to go get the 2-piece and biscuit and save your money, or not get it at all. So yeah, seeing where your funds go and budgeting definitely helps. So something that I do pretty frequently this time of year is, typically a lot of companies and subscription-based companies offer some sort of bundle discount or discount for Black Friday to pick up their subscription numbers for the Christmas holiday. We did that to bundle Disney and Hulu, and we saved money. However, we got rid of Disney and Hulu, if you know what I mean. But when we did it, we bundled it. My wife had Apple Music. Apple Music, Apple TV, and then maybe like Apple Games or something like that. I'm an Android person. And then I had her look at it, and she bundled them together, and she saved money. So like, just looking, some things you get rid of, some things you can keep. But even if you reduce, by $10 a month, that's $10 a month you save. Like my wife and I both had Xfinity in our Xfinity, Sirius XM in our cars, in our trucks. And one day I was looking, I called and I said, hey, is there a plan where you can budget for multiple cars? And she was like, sure. And we ended up saving like $15 a month, because she was paying her bill, I was paying mine. I mean, we're in the same household. So when we bundled it together, we ended up saving money on the same service we were using anyway. So, check into that. You guys aren't, some of you are, if you're a homeowner, make sure you're getting the best insurance rate that you can get, potentially bundling your home and your auto, things like that. But yeah, budgets make a huge difference in knowing where your money's going, and what you can cut down on and what you can save on and get rid of. Asking because I want to buy a house real soon. Any deduction will help. You're right. Any deduction will help. If it's $100 a month that you save, that's $100 a month that you can have to put towards your retirement, whatever you want to do. So yeah, those type of those are the only benefits you get in Georgia for seniors. Great question, Miss Debbie. So Fannie Mae has come. So Fannie Mae is a quasi-government entity that backs conventional financing. And what they've done is they said, hey, as of November the 16th, 2025, the minimum credit score that we were utilizing for conventional financing of 620, we're taking away. So that is true, right? The reason why they did it is because they're trying to make potentially make more homeowners eligible for conventional financing for a couple of reasons, right? First reason is if a person has a 620 credit score, it's typically viewed as they've got some issues. But they look with conventional financing, they look for stability and job. So you got to have a job history, potentially on the same job for a specific period of time. You can't have any mortgage lates if you have a mortgage. You can't have a ton of or many lates on credit cards, collections. Like your credit profile still has to have a certain look. Sometimes a 620 is the score that a person has, and that's just what they have. We don't control the scoring algorithm, but I'm like, hey, this person's score should be higher. Why isn't it? Desktop underwriting system reads it and it doesn't approve you because of 620 credit score. They've removed that barrier. The challenge that we're going to have is two things. One, mortgage companies are going to have to remove that from their guideline. And then the other thing is mortgage insurance. So in private mortgage insurance, to qualify, you typically need a 620 credit score, which is the rule for conventional. So because Fannie Mae took that away, private mortgage insurance or PMI will need to make an adjustment on the scores. The catch is when you have a lower credit score and you're not putting down at least 10 to 20%. 20% makes mortgage insurance go away on conventional financing. 10% helps reduce it. 10% and above helps reduce it. However, if you're putting down 3 and 5%, you're going to have high private mortgage insurance because the credit score is risk-based on the mortgage insurance. So if they don't change the mortgage insurance requirement, the only way you're going to qualify is if you put 20% down or pay off the mortgage insurance. So there's some things that need to be adjusted. But that is a fact that they removed that requirement. But that doesn't mean that you automatically are going to qualify. They're opening it up, but there's still some adjustments that need to be made. The second part is they are looking, and I say quasi-government, they're not technically government entities, but they get something from the government, right? And they're looking to take Fannie Mae and Freddie Mac to private equity. So if they get more people in houses because they remove that barrier and then it gets sold off into private equity, then that creates more money for the private equity firms. It puts more people in homes, but it also creates more for private equity firms. I think it's a good Chanel. I think it's a somewhat good thing because all 620 credit scores aren't created equal. There's some who have lates and had challenges that have 620 credit scores. There's some people who had higher scores. They missed some payments and their score dropped to 620 or below what it was and maybe the 620. And then there's some people who just have a 620 credit score because they established credit. They've been on their job for a long period of time, don't have a lot of debt. I think they should be able to qualify for conventional financing. Conventional financing is very conservative. I think it will help some people, but again, you still have to compare. Does it make more sense to go conventional? Because conventional typically has higher interest rate, and if your score is lower, you're going to have higher mortgage insurance versus FHA, who has a lower rate and probably going to have better mortgage insurance. Because the mortgage insurance for FHA is based off the price of the home, not the person's credit or risk. I'm in favor for it. I think it may help some people, especially on the refi side. So I'm in favor for it. I just need to see how the adjustments are going to be made. What type of homes qualify for a mortgage? Example, manufactured, tiny, shed, etc. Manufactured housing, double wide, single wide, stick built home. There's financing for some tiny homes. Have not seen anything where you can qualify for a shed. But I think I know what you're talking about. So, stick built, manufactured, a modular, which is a manufactured home built in a controlled setting on the inside versus, is a modular home is a stick built home built inside of a factory away from the elements and then brought to site and then put together at site. So it's still stick built. It's just a modular because it's typically brought to the lot in two pieces. But those qualify. There's some financing that allow for you to get barn dominium, but you typically have to have more money down. Then there is even some financing options with larger down payments for log cabins and different properties, such condominiums, townhouses, container homes on a primary residence. No investment. You're starting to see some people allow for financing on container homes. Hopefully that helped, Miss Suzanette. Did you confirm from Shahida about interviewing her? I reached out to Miss Hill and I have not gotten a response back from her. So I will reach out to her again this week, but I don't see where there'll be a problem. So Miss Jones, it's not going to be ratchet TV. We're not going to be arguing about whether we should go to 3 lenders or 1. We're going to discuss it, but we're not going to argue about it. But yeah, I'll reach out to her and make sure. I know her kids are playing sports and probably wrapping up for the season, but I don't see where it'd be a problem. But I reached out to her last week and I hadn't heard back from her. Why do they punish you? Why do they punish you for paying off a loan early? Do you think they will change that? So, Cynthia, I don't know why your score drops temporarily when you pay something off earlier. I believe that it's because, let's say it's a car, and outside of your mortgage and maybe student loan debt, your car payment is probably going to be the longest piece of credit that you have. And I think once you pay it off and that item is no longer reporting its history and no longer reporting, I think that's why we see a drop in credit scores. I haven't seen it be a drastic drop because I've had people pay off their cars or pay off their car because they refinanced to get a lower payment. We saw a slight drop, a couple of points, but there is a drop. Do I think they'll change it? Probably not. It's a part of their system. Which mean, oh man, we're not fighting. It's nothing but love over here. Love. Again, guys, if you're watching the replay and you have a question pertaining to understanding and improving your credit, do me a huge favor. Drop your comment below. I'll do my best to answer your question. If you're just joining, we talked about understanding and improving credit. And by understanding your credit will help you begin to learn how to improve your credit. Again, I understand that life happens. There's no quick fix to repairing your credit. If your credit's been bad for 5-6 years, it's going to take some time to fix. If you've had a mishap in the last 12-24 months, it's just going to take some time to potentially fix it. I would not invest a ton of money in someone who says they can get it off quickly. The credit repair companies that I utilize typically quote people anywhere between 6 to 8 months to get things situated and improve. And they also give you things that you can do to improve your credit. Sometimes I'll again, the link for the secure credit card will be below. Also there below in that link, if you need to establish credit, and this is, I didn't touch on this. When you establish credit or reestablish credit, you want to make sure you have at least one revolving credit line, which is a credit card. And then you want to make sure you have some sort of installment payment. So that could be, I'm not saying go buy a car, but installment payment is a car payment, a personal loan, their secured personal loans. Like, I'm going to have some links below where you guys can look at what service on there can help you reestablish your credit, whether secure credit card, secure line of credit, secure personal loan, just to reestablish credit and say, hey, I'm pledging this $1,000. I'll pay back, X amount of dollars on a monthly basis to reestablish my credit. And you're just using money that you put up to pay down to reestablish your credit. What if a person has 700 plus score, but their credit utilization is over 80%? Could they still qualify for a home? No. If it's their total credit utilization, it just kind of depends. So example, say you have $1,000 credit card and your balance is $800. That's 80% credit utilization. However, let's say that $100 a month that you're paying on that credit card is the only debt you have, then yeah, you can qualify. And that's the thing that I think people get confused. Utilization and debt to income ratio are two different things. Your utilization is what part of your credit is used. So example that I just gave you, $1,000, $800 payment. $800 balance. That means your credit utilization on that credit card is 80%, right? But that doesn't mean that you don't qualify, because your debt to income ratio is your total debt to your income. What's the ratio? If you make $5,000 a month, you got a $150 credit card payment, a $500 a month car payment, you've got $650 that go out on a monthly basis towards debt. On that $5,000, and you're using FHA, we can allow for you to use up to 56% of that income. Your debt to income ratio is going to be low, depending on what type of house you buy, but your utilization is high. So those are two different things. But utilization can be high, but it's all going to matter on the additional debt. So typically, utilization, if it's high, the way we get it down is we figure out, okay, Miss Jones wants to buy a $300,000 house. Right now, we can get it at $275. If we pay down XYZ credit card and we get that payment down and the balance down, then that will help her qualify for more. So hopefully that answered your question. I know I went around about, but I want to make sure people understand that utilization and debt to income ratio are two different things. And it's all going to depend on what your debt to income ratio is, meaning whether you need to do something about your credit card utilization. Credit card utilization does affect your credit score, but you said, hey, if I have a 700 plus, that just means when you get that utilization down, your score should increase even more. No problem. I got time for a few more questions. Also, guys, if you are watching the channel or watching this live, do me a huge favor and give me a thumbs up. It is free for a thumbs up. Hopefully you're enjoying and getting information that you need. I will say right now, there's a lot of things going on in the mortgage space. Like we mentioned, Fannie Mae is getting rid of credit score requirements. They're also considering getting rid of LLPAs, loan level pricing adjustments on investment properties and second homes, and cash out refinances. What does that mean? Okay, you've got equity in your home and you want to pull it out. We'll give you some cash, but we're going to charge you. We're going to tax you for using your cash from your equity. We saw this increase during, COVID and the pandemic, because I think it was a mechanism to try to slow people down from refinancing their home or taking cash out to buy investment properties, so that people look for primary residence could purchase homes. So reducing those loan level price adjustments on second homes, cash out refinances, and investments, that will help people have to bring less money to closing. Loan level pricing, in layman's terms, is discount points charged to get a specific rate or to pull cash out of the property. Hopefully that made sense. Along with, like if you're in the market looking to purchase a home, I still believe you can buy by the end of the year as long as everything lines up. Because right now, realtors, lenders, not all, some realtors, some lenders, some buyers say, hey, it's almost holiday time. I'm focused on stuffing this turkey and getting Christmas gifts. I'll work on this house thing next year. In the meantime, you have sellers who are like, man, I need to sell my house so I can get into another house or get to where I need to go or do what I need to do for my family. Help me. So if you're currently looking or want to look and see if you can get to a house, I still believe that you can get into a house by the end of the year. It's going to take a couple of things. It's going to take you to be in the greatest processor in the process by getting us the documentation. And then the only other way is once you get approved is having the ability to go out and identify your property in a pretty quick fashion. If you're going to be super, not picky, but super specific on exactly what you want, that could take you a little longer and it may not happen by the end of the year, but it is a possibility to close by the end of the year. Never heard of loan level pricing. Yep. It's a lot to it, Miss Jones. Essentially it's discount points, but yeah, the loan level pricing adjustments are the adjustments that they make to, specifically on cash out refinances. So it would call, if you were doing a rate and term refinance where you just wanted to get minimal cash to take care of your closing costs, and you really want to get that, let's say you got 7.125 interest rate and right now you could, let's say you could get a 6, then that pricing to get that close would cost less if you say, hey, I want to go from 1.25 to 6, but I also want to pull out $60,000. They're going to charge you for that $60,000, so it's going to be higher. So again, guys, if you have any questions, drop them in the chat. Let me know if this is helpful. I enjoyed going live. There was a period of time where I had stopped because I couldn't get adjusted because of sports. But now we're done until at least January. I want to make sure I get on here and help educate you guys as much as possible. Did anyone have any additional questions about credit? We got you. Miss Jones, what show you trying to watch? What show come on at 8 o'clock that you watching? While we wait for Miss Jones to answer, or see if she answers. Again, let me know if you got any questions. If you're watching the replay, do me a huge favor. Make sure you give us a thumbs up to push out the YouTube algorithm. If you have any questions pertaining to home ownership, let me know. If you'd like to book a consultation with me, the link will be in the description. Thank you guys and ladies for coming out tonight. I'm Kevin Jefferson, the People's Lender. Have a great night. And all the housewives, I got you. Good night, guys.